Okay, the foreign earned income exclusion now has gone up through the roof. It's incredible how much they've increased this. They only had an increase of 3% the prior year, but now it's increased to over 7% increase for this year, for 2023. Now, the foreign earned income exclusion, if you meet certain requirements, you may qualify for this exclusion. The foreign housing exclusion and also the foreign housing deduction. To claim these benefits, you must be or have foreign earned income. Your tax home must be in a foreign country, and you must have one of these 3 qualifications that I'm going to tell you right now. Also, folks, if you want to legally get around your high taxes or how to get a second passport as quick as 45 days, do 3 things. Hit the subscribe button at the right of your screen right here, and you get new videos automatically as they come out. And number 2 is I would like to hear from you. If you got a question or comment, put it below. And number 3 is go to our website, www.citizenshipquickly.com, and just ask for some help. Okay, you have to qualify under one of these 3 categories here: a U.S. citizen who is a bona fide resident of a foreign country or countries for an uninterrupted period that includes an entire tax year. The other option is a U.S. resident alien who is a citizen or national of a country for which the United States has an income tax treaty in effect, or who's a bona fide resident of a foreign country or countries for an uninterrupted period that includes an entire tax year. Another option is a U.S. citizen or U.S. resident who is physically present in a foreign country or countries for at least 330 full days during any period of 12 consecutive months. Now, you can use the IRS Interactive Tax Assistant tool to help determine whether income earned in a foreign country is eligible to be excluded from income reported on your U.S. federal tax return. You can do a Google search on that. So, these are some things that you can do. But remember, all of these exclusions here is not going to benefit you unless you go to a place that doesn't have an income tax. Okay, this is why I like St. Kitts and Nevis, because there's no income tax, no capital gains tax, no estate tax, no inheritance tax. If you take this exclusion and you go to a place like Germany that has higher taxes than the U.S., then the first deductible amount that they're allowing you in the U.S. to be excluded from taxes, you're going to end up paying Germany's taxes. In other words, you're going to have an income tax at a higher amount than what you would in the U.S. This only benefits you if you go to a pure tax-haven country that does not have an income tax. Or you go to a territorial tax system if your income is made outside the country. It will work for you in that instance, like Panama, Nicaragua, countries that have territorial tax systems, okay? So you have to know what you're doing when you use this exclusion. Otherwise, you can end up paying more taxes than what you were making in the U.S. if you move abroad. Now, if you are a U.S. citizen or a resident alien of the United States and you live abroad, you're taxed on your worldwide income. However, you may qualify to exclude on foreign earnings from income up to an amount that is adjusted annually for inflation. Like, for instance, in 2020, it was $107,600 exclusion per person that exclude from your taxes. If you had a husband and wife doing a joint return, you could double that times 2 if both of you worked and you both qualified and lived abroad and met that qualification. For 2021, it was $108,700, and then 2022, it went up to $112,000. Now for 2023, it's $120,000 per person. That's $240,000 for husband and wife together, if you're both making income, okay, up to those limits. Now, in addition, you can exclude or deduct a certain amount of housing amounts. Now, you may also be entitled to exclude from income the value of meals, lodging provided to you and your employer on your premises for their convenience. Now, however, such amounts on foreign earned income is going to be based on these factors. Now, you can go on the internet and pull up more stuff on this to get a better understanding of how it works. But this is the big key to take away from this: is you're going to have $120,000 deduction for husband and wife. That's $240,000 a year. This will only work if you go to a pure tax-saving country or a territorial tax country, okay? And by doing this, you can exclude up to these limits of $120,000 for husband and $120,000 for wife if both of you are working. Man, this is a tremendous tax deduction. And also if you have a foreign corporation set up and that foreign corporation pays you your salaries, you can eliminate all your FICA taxes if you qualify for the foreign earned income exclusion. If you want to know more on this, folks, go to our website, www.citizenshipquickly.com, and just ask for some help. And I would like to hear from you. If you got a question or comment, put it below. And again, if you want more videos like this, hit the subscribe button at the right of your screen right here, and you get new videos automatically as they come out. And I look forward to talking to you in the next video. Take care.